Hello friends, welcome back to my channel. In today's video, I will discuss PE ratio. By the end of this video, you will be able to understand what is PE ratio and how PE ratio will help you in taking a correct decision on when to invest in a particular stock. PE ratio is the most commonly used term in a stock market. It is the ratio of price of the share to its earning per share. Now let's try to understand how P of a stock increases or decreases. In numerator, you can see the price of the stock, and in denominator, it is earning per share. Earning per share is calculated by dividing net profit to its number of shares. Now, net profit is calculated either quarterly or yearly. So, net profit would remain same for at least 3 months. So, we can say that earning per share will remain constant for at least 3 months, but the stock price of a share will increase or decrease daily as it is traded in the stock market daily. Let's try to understand it with an example where the current market price of a stock is 100 rupees and its earning per share is 10 rupees. In this case, the PE will be 100 divided by 10, that is 10. Now, the stock price will change daily, but the earning per share will remain constant for at least 3 months. Let's assume that the stock price increases from 100 rupees to 110 rupees. In this case, the PE will increase to 11, and if the stock price decreases to 90 rupees, the PE will go down to 9. It is clear that till the next quarter results are declared, the earning per share will remain same and the PE will depend only upon the movement of a stock price. Now let's assume that in the next quarter earning per share increases from rupees 10 to rupees 20 and stock price remains same. In this case, PE will be 5. Until the next quarter results are declared, the earning per share will remain constant, that is 20, and PE will completely depend upon the stock price movement, that is share price movement. Let's say it increases from 100 rupees to 160 rupees, then the PE will become 8. Now, the natural question which arises in mind is, if the earning per share remains constant for a quarter, why does the stock price increases or decreases? If the stock price of a company is increasing, it clearly depicts that analysts have analyzed that in coming quarters, profit of the company is going to increase, that is, earning per share will increase. In this anticipation, the share price of a company increases. And in case the share price is decreasing, it clearly depicts that analysts have analyzed that in coming quarters, the profit is going to decrease, which in turn will decrease the earning per share. So, in general, it is said that a company with high PE indicates that analysts are expecting high revenue growth and future for that company is bright as compared to the companies with low PE. The second takeaway from PE ratio is that it gives a measure that how costly is the stock, or precisely we can say that how much you have to invest in a stock to earn 1 rupee from that stock. That is, if the PE ratio of a stock is 30, it means that you have to invest 30 rupees in that stock to earn 1 rupee. Extending this argument to the higher level, we can say that a company with higher PE is costlier as compared to the company with lower PE. But when we are comparing two companies on the basis of their PE ratio, we should keep in mind that these two companies should be from the same sector. For example, we cannot compare the PE of HDFC Bank with TCS. These two companies are from different sectors. We can compare PE of TCS with Infosys, Wipro, SCL Tech, and those companies which are from IT sector. Similarly, the PE of HDFC Bank should be compared with the PE of ICICI Bank, SBI, Yes Bank, and those companies which are in banking sector. The growth and future earnings of different sectors depend upon different macroeconomic factors. This is the reason why we cannot compare the performance of two different companies from two different sectors on the basis of their PE ratio. Let's try to understand it with an example. During COVID period, the PE ratio of pharma companies as well as companies related to medical sciences increased. This happened because during COVID period, analysts have analyzed that the future earnings of these companies is going to increase. But on the other hand, the PE ratio of consumer durable companies decreased, as it was evident that their sales have decreased, which will impact their net profits in coming quarters. Now we will see how PE ratio will help us in taking a correct decision before investing in a stock. Before taking a final decision on investment in a stock, we should compare its PE ratio with its peers. For example, if you want to invest in TCS, you should first compare its present PE with its competitors' PE like Infosys, Wipro, SCL Tech. It will give you an idea that whether TCS is presently more costlier as compared to its peers or is cheaper as compared to its peers. Also, you should compare the present PE of TCS with its last 3 years PE. It will give you an idea that how the performance of the company has been for last 3 years. Hope this video was insightful, and to watch more such videos related to stock market, kindly subscribe to my channel and press the like button. Thanks a lot for watching.